Welcome to my video. This particular video, I'm focusing on my NVDA trade that I took on the 24th of February, and I'm going to go through the mechanics of what my ideal scenario would have been. And unfortunately, that scenario did not happen. So, how am I managing that trade in the future? Some level of option knowledge is actually assumed in this video. If you do not have that, what I encourage you to do is go to my other videos on long calls and covered calls, which if I have not posted right now, I'll be posting them pretty soon. So with that, welcome to this NVIDIA long call strategy that I actually took on my account. Before actually going through the mechanics of this trade, I want to quickly flash this disclaimer out. First and foremost, I am not a financial advisor. This content is for educational purposes. Options use leverage and thus involve risk of considerable loss. It may not be suitable for everybody. So I'm placing these trades based on my own risk appetite. Definitely do your own research for any particular strategy, whether it's suitable for you, and go through necessary what if scenarios if the trade does go against you. Last but not the least, this pretty much applies for all my content. Think about this as brainstorming sessions rather than financial advice, and ask questions and I will try to answer them to the best of my ability in the comment section. So let's go through the trade now. So what was my thinking behind this NVIDIA trade? First and foremost, NVIDIA is a strong company and it has pretty good earnings. I don't mind staying in that trade even if it goes against me. As you can see from this chart, NVIDIA was range bound almost since October between 170 and 195. On February 25th, one day before the earnings, it started poking out of that ceiling. My hypothesis was that, with the strong earnings, possibly it actually would have opportunity to break out of this ceiling and go to the next level, possibly 212-ish. So that was the reason I took this trade. And again, if that trade does go against me, I do not mind staying in that trade for a longer period of time till I hit my profit targets. Before actually going into the NVIDIA strategy, I wanted to quickly discuss this particular slide, which talks about how I can use a long call that is deep in the money as stock substitution. So why would I do that? First and foremost, I would be using significantly lower capital than actually buying physically 100 shares of the stock. My downside would be significantly reduced compared to buying 100 shares of stock and that stock going down. And last but not the least, because the call is deep in the money, my exposure to time decay is much less. So my thought process is that what if I used, instead of buying shares outright, maybe 10 to 20% of my portfolio using long calls? That obviously is because of leverage is going to give me higher rate of return. And that would pretty much help me spice up my entire portfolio. That's my sort of thinking of how I would use long calls. So this is how the payout graph of that long call is looking like. So this graph is assuming the stock is trading today at $100. I'm buying a long call, which is 50 days approximately away in time and approximately 90 to 95 delta. As you can see on the upside, it doesn't matter if I'm today about halfway between expiration or at expiration, I'm going to get almost a one-on-one movement. Because remember just what delta is. A 90 to 95 delta option means that for every $1 of stock movement, my option itself is going to move almost 90 to 95% of that. So for example, in this case, when the stock moves from 100 to 120, My 100 shares would have made me a profit of 2000. My options are making me pretty much that profit, approximately 1900 ish. So that's on the upside. Notice how these three lines have converged, meaning that there is really no time exposure that I have. It doesn't matter if I'm, like I said, today at expiration or mid time. In fact, how far these lines away are pretty much tell me what my time exposure is. In the beginning, because my delta is, hey, it's not one, but it's 90, like 95. I have a very, very small time exposure, as you can see here. But as I go further up, pretty much that time exposure is reduced to nothing. On the other side, if I go down, two things I want to point out. Again, like I said before, my downside exposure is only limited to 1500, the amount I paid for this option. Whereas for stock, if my shares went to, if my stock price went to zero, I would lose $10,000, right? So that's basically the other advantage. What's going to happen is if my stock goes down, now notice how these three lines actually diverge from each other. So in a particular extreme scenario, suppose that stock went from say 100 to $85 today itself, then I would immediately show a paper loss of approximately 1,000 or 1,200 in this case. If the stock stayed at that $85 level for the rest of the time till expiration, then I would start actually losing money because of time. This blue line is now going towards this red line at expiration. So then I would pretty much go from $1,200 to my maximum amount of money that I paid for the option, which is 1,500. So my theta decay is going to be basically the rest of the $300. Let's jump into the Excel sheet really quickly to show this in terms of numbers. All right, so let's actually look at this scenario that I showed in the graph previously with actual numbers. And this is a simple spreadsheet that I've made. So what's going on is, assuming the current stock price is $100 for simplicity, I'm going to go and buy a call with a strike price of 85 and 50 days to expire. I'm going to get a delta of 0.91 for that call, and I'm going to pay 1560. Remember, it's 100 shares, so multiply by 100 the initial cost. Now let's look at the scenario in which the stock price goes to 110. So if I had 100 shares, my profit would be basically the difference, which is 10 times 100, which is 1,000. But I don't make quite $1,000 because of this delta. Let me explain why this delta actually is changing. And that's because delta is not static. The delta itself moves as the stock price moves and as the time evolves, as time starts ticking. So it's dynamic. But as a rule of thumb, what you can say is that, hey, let's look at the average of these two numbers, which falls about 0.95, 0.96, and multiply it by the profit that you would have made if you had 100 shares. So that gives you basically the profit that you are seeing here, 951-ish. Notice another thing, and that is the extrinsic value. As I mentioned in the previous lecture, because the delta is so high, we are deep in the money, the extrinsic or time value of that option is pretty much negligible. And that's what you can see pretty much here. Now let's look at the opposite scenario in which the stock suppose falls to $85. Now, what's happening is the delta again itself is going down from 0.91 to 0.53. Again, the loss is not quite what you would have for 100 shares. If you had 100 shares, your loss would be at that point $1,500, right? 85. So 100 minus 85, $15 times 100. But it is not quite that. And you probably could use the same rule of thumb. So let's think about this. So the average of 0.91 and 0.53, what you get is about 0.72. And you multiply that number by the loss if you had 100 shares, and your loss is about 1100-ish is what you're getting here. It's not exact, it's a rule of thumb, but it is giving you a pretty darn close number. Again, remember, this is basically the same day, suppose the stock moved. What has happened immediately is because this option now has gone pretty much close to at the money, your delta has gone down. What's going to happen now is as the days roll by, you are going to basically realize, and if the stock price remains exactly at 85, as the days keep rolling by, you're going to see that this loss starts mounting up. So once the whole 50 days are gone, what's going to happen is you are still going to be limited to that 1560 loss approximately. All right, let's jump into my NVIDIA trade now. So it is 25th of February at about 2:30 p.m. The stock is running around 196, 197, and earnings are tomorrow. I didn't want to take too much of an aggressive position, so I bought a long call about 37 to 40 days away with a 70 delta, not quite 90 delta, but 70 delta. To make it less aggressive, I actually sold a short call 1 week away. And the advantage of doing that is, first of all, there was a lot of premium in that due to the volatility buildup that happens before earnings. And the volatility crush that would happen the next day would actually, hopefully, help me out with that short call. My sweet spot would be when the stock is around 205 to 210, because what's going to happen is, notice this is the profit and loss curve of that trade. A long call profit and loss would just keep on going straight up. The more the stock goes up, the more the profit. But because of that short call, that is going to be capped on the upside here. In fact, this is looking very much like a covered call strategy. For a covered call, as a reminder, you buy 100 shares. So on the downside, you pretty much have a potential of basically the full loss, stock going to zero. And for a stock at about 197, that's a $20,000 loss minus the premium that you're getting. And you're capped on the upside. So that red line represents a covered call. Just as a reminder, those who don't know what a covered call is, please look for my videos in this series on covered calls specifically as income generation. In any case, so basically the point of doing this trade is first and foremost less aggressive, and secondly, as you can see, for a covered call, my capital cost would be much more. 100 shares minus the premium, it would be running around almost 19K. Instead of that, I actually was able to do a strategy which represented pretty close to the covered call profit and loss for almost around less than about $2,000. So with that background, let's actually jump into the trade and the management, because as you remember, the trade really didn't quite go the way I liked it. All right, so here is that Excel sheet which is simulating the NVIDIA trade. And let's go from the top to the bottom of the spreadsheet. So as you can see, on 25th of February, NVIDIA was trading at around $197. So what I did was I bought the call with approximately zero point 0.7 delta with a strike price of 185 and about 37 days to expire. The cost of that trade was 1965. Simultaneously, I also sold another call with a strike price of 205 only 8 days away, and I got a premium credit of 3.36. So in fact, the cost of my trade went down about 19.6 minus 3.36, which is about $16.3. So that was my trade. Now, my best case scenario after earnings had happened would have been, and that's where you go to these two lines here, is that the stock would have gone to 205. So notice what I have done. This column here represents the time that as it evolves versus this is actually the expiry time. So this always never changes. 1 day has passed, I mean, on 26th of February now. At $205 stock price, as you can see, my long call has made a profit approximately $500. My short call is still at a loss because only 1 day has passed. But notice what happens if 8 days now pass. My short call pretty much has, I've got back all my premium on the short call. So I've made a profit on the long and the short call. And my overall profit is 684. What's going to happen is it's not going to matter how high the stock goes, though. In fact, I'm going to probably slowly start going into a lesser of a profit if the stock goes way too up. Again, remember that was because of the risk graph that we had shown. My sweet spot was about 205. So that's what my ideal situation would have been. This would have been my profit and loss in a day after the expiry. All right, so let's now look at the management of this trade. So first and foremost, what happened was after the earnings came out, the stock didn't do quite what I expected. In fact, what happened is when it went to about 186, I actually decided that I need to make an adjustment. So that's what I'm doing now to simulate that. On the 26th of February, the stock has gone down to 186 and 1 day has passed. Again, as a reminder, this is the time that evolves and this is the time to expiration of that option, which doesn't really change. So where am I right now? I'm basically at a approximate loss of $500. What's happened is my short call actually has pretty much made all the money. My long call has made a loss because the stock went down. My delta has gone from zero point 0.7 to 0.55, and I don't like that because notice what's happening to my extrinsic value. Now I have a lot of exposure to time. So how did I manage this? And that's really the interesting part. So what I did is think about this now. So what I'm doing is I'm basically taking the loss. So I'm going to sell this combination off and take a actual loss of about $500, and I'm going to reestablish this trade. And that's, folks, is what the fascinating part of this is. What I'm going to be doing is I'm actually going to reestablish this trade by rolling up that delta above 80. So my new delta goes from 0.55 to 0.83. And folks, what does that really mean? Is now I'm actually, when the stock goes down, I'm buying an equivalent of approximately 30 more shares at a lower price. That's basically what this means. Pause this video to think about what I'm saying here. And again, I always like to go short, so I'm going to establish a short position to limit my exposure on the downside slightly. So I sold a short call, again, about 8 to 9 days away. Now rolling this from 205 to 200 as well. So this is where I am right now. So then let's actually look at this now. What really is my break even? And that's what, folks, is the interesting part. So what's going to happen is I'm going to now start changing this. So I've simply copied this trade over here. I'm going to simply start seeing at what stock price I actually break even. So notice what's happening here. This is a loss that I've actually booked from the previous trade. This is the profit and loss of basically all these two trades. So basically the sum of these two numbers and these two numbers is going to give me my overall profit and loss on that trade. So let's keep doing this. So let's see, now 192. Now, folks, you can see that you are actually pretty darn close to break even. Now let's see what happens when, say, 4 days have passed. What's going to happen is now, in fact, I'm actually slightly in a profit overall. And that's pretty interesting. What's happening is I do not need the stock to go all the way above what I traded. to even start making a profit. That's really the cool part out of this. And the reason for that is because I rolled that delta from 0.55 to 0.83, if you remember. And that's basically, I bought equivalently, I bought 30 shares more. So the price did not have to go all the way up to 197 to make a profit. In fact, what you're going to be seeing now is if 9 days go, my short call is actually going to make me some profit as well. And I'm actually placed at a pretty darn good profit. Let's just make this 197 to see what's going on. There you go, folks. That's really the interesting part here. That it's like a roundabout. I'm going dipping all the way down, reestablish my position, and then all I need is to come back to that original price when I started this whole saga to pretty much go back to the profit that I was kind of hoping. Not quite that, but about that, right? So that's the interesting part of options. This delta, the fact that it is dynamic and it actually moves in the correct direction. When the stock goes down, the delta itself goes down, and when the stock goes up, the delta will go up. Again, notice what's happened to that delta. The stock, when it goes up, my delta actually went from 0.83 to 0.91. So that's all, folks. I'm going to now wait to pretty much see when NVIDIA goes up. Hopefully, it goes back to the ceiling, which was about 197, 198. And I will try to get out of that trade then.